Brent, what are you telling your clients this morning?
To stay steady. I mean, I think the near-term impact of this will be felt, which you're feeling it today. But I think if you look at the underlying conditions when you came into this downturn, or at least this coronavirus fears, you actually have a lot of stimulus in the U.S. economy, in the global economy, that will begin filtering through that economy in the next 3, 6, 9 months, which will provide a tailwind to actually future economic growth. And so that's our underlying outlook based upon the fundamentals, not based upon the fears. And so we would advise sticking with stocks at this point.
When you talk about stimulus coming to make everything better, are you talking about central banks or fiscal stimulus like tax cuts or what?
Sure. I think the main part is the monetary stimulus. So if this would have hit last year, you had an economy globally that was getting monetary policy increases. So if you looked in 17, 16, 15, you actually had rates rising. Now you actually have had rates falling for the past year. You've actually had more stimulus applied in China. And we do think that will eventually steady growth as you look into the future.
What about the uncertainty factor of Italy? Now schools are closed in Milan this week, of South Korea, where the numbers are sort of rising exponentially, and the continued disruption that's going to have on travel and, cross-border activity, supply chains. Can you really get at that with monetary stimulus?
Right. I mean, without a doubt, there's going to be an impact. But I want to point out and just kind of take a step back. I mean, while those are increasing, the ones in China are actually decreasing, at least the news that we have. If you look a few days ago, there were 58,000 active cases. Kind of quietly, we're now down to 52,000 active cases because the number of recoveries is exceeding the number of new cases. Those are certainly risk, without a doubt. Risk that we don't know how to quantify per se. But what I do know is that the underlying fundamentals, I believe, are still strong. We're actually strengthening before this actually happened. And as we eventually exit the opposite side of it, I do think you will see actually recovering growth, which will lead stocks higher. If we wake up 2 weeks from now and this thing has passed, which I'm not suggesting it will, but perhaps, the 10-year Treasury yields 1.4%. Inflation is above that. What might investors be wanting to do in that environment? Look towards bonds or look towards stocks for future economic growth or market growth?
In your case, is it's clearly stocks. I also want to welcome in Margaret Patel to this conversation from Wells Fargo Investment Management. Margaret, Brent was just making the case that there's going to be a lot of monetary stimulus and that in a few weeks, stocks are going to be an attractive bet, so investors should stay steady. Do you agree with that?
Yes, I do, because already last year we were beginning to feel the effects of that easing, and many governments around the world have actually increased the amount of easing that they've done in reaction to this coronavirus. So I think that'll soften the cutbacks we'll see in growth in the first and the second quarter and lead for a second half that'll be stronger than many people, I think, are expecting right now.
So, Margie, what do you do with a group like energy, which is getting hit the hardest, down 4% in terms of the energy stocks right now as crude sells off? Do you buy a group like that or stay away because it's too risky as these concerns spread?
We have practically no exposure in energy. We haven't liked that sector for quite a while. We're pretty much avoiding any commodity-related sector because most of that really feeds into China demand, which we think will be very badly hurt, as well as demand from emerging markets that will be hurt. So we, like other sectors like healthcare and industrials and even the utility sector, we think will be much better sectors to be in than a commodity sector like energy.
Brian, what about you, sector-wise? What do you like?
Yeah, so I think what you saw last year towards the end of the year when the political uncertainty kind of started ebbing and you actually had that stimulus filtering into the economy, you saw more cyclical asset classes outperforming because people started pricing in the fact that we weren't likely to have a recession. That worked up until about January 20th, and then people became more defensive again. We do think that as those storm clouds subside, as that stimulus begins to weave into the U.S. economy and global economy, that you'll actually see cyclical asset classes, perhaps like the one that was previously mentioned, outperform because their valuations are cheap, and people are right now crowded into defensive sectors based upon first their trade war fears, which have kind of gone down, and now these coronavirus fears, which we do think will eventually pass also.
Very quickly, Margie, do you buy the chip stocks? I mean, they've been really buffeted around here on supply chain concerns and disruptions.
Yes, we like the chip stocks. We think they've been great investments. We think they've hit a turning point in their cycle. We expect them to continue to do well, and we have an exposure there that we like.